Just to give you an update, we're working on a more detailed presentation deck that we'll be presenting on Friday in a video format. They'll go into a lot of historical data. As the level of panic seems to rise at times, refocusing on the data helps us get perspective and context. So we think it's important that we share that data with you that we look at. And so we'll be doing that on Friday. So look out for a video from us late on Friday. We wanted to provide another update on the market as we sit here today on Wednesday after another down day in the market. We had a retest of the S&P December 18 lows that we successfully held now for the second time. So we wanted to talk a little bit about what that means, what our thinking is around that, and then also talk a little bit about how we're thinking about all the recent developments. The news has been fast and furious, and keeping up with everything that's going on around the virus, the economic stimulus, the monetary stimulus. There's a lot of information. So we'll talk through sort of the framework that we use to think through all that information. So perhaps first we'll start with the S&P today and where we ended up and what that means.
So today down a little over 5%, not as bad as we were intraday. But as you were saying, when you get severe drawdowns like this, the first thing you're looking for when you're trying to say, when are we going to get back in? When's the appropriate time to buy? You need to see evidence that a bottom is forming. And there you draw a line in the sand and you think, how many times do we hold that line in the sand? That new line in the sand is a closing of 2381. And then your intraday line in the sand is 2351. 2351 on the S&P 500 being the low from December 24th, 2018. Mm-hmm. That's our new line in the sand. We've tried to make lines in the sand over the prior 3 weeks, and ultimately they haven't held up as bottoms. We've broken lower.
Right.
But we have held this new line in the sand a few times now. So that's typically how these things play out. First, you form a bottom. Then you retrace some of your losses, usually anywhere from 20 to 50% of your losses, and then you double bottom, retest it before you move higher. That's normally how these play out. Right. First step, we need to form a bottom. It was ugly today, but still evidence we're forming a bottom.
Right. And it's early in the process, right? So it's not as if there's any golden rule here that says this is a bottom, but clearly, if you follow technical analysis, these are indicators that we're starting to find a bottom or find a trading range with the information that's already available in the market and what's essentially priced in, which we'll talk about in a few minutes. So thinking about the information that's priced in and how we think about information in the market, we think about things that are generally already priced into the market or what we call that are known by the market. Maybe we can talk through a few of those. So let's start with COVID-19. We already know that this is a pandemic, right? Mm-hmm. So there isn't anybody who doesn't know that. And we know that at least the number of confirmed cases in the US and probably globally are going to continue to rise. Unfortunately, the number of deaths in the US and globally are going to continue to rise, and that information is all priced in.
Yes. Right. Yes. Yeah. We also know there will be economic damage. Jobs will be lost. We also know
already being lost.
Yeah, they're already being lost. We know people are panicking. Panicking the most we've seen since 2008, maybe more than that. And we know global equities have been damaged. They're down anywhere from 20 to 30%, depending on what you look at. All of that, what we call the known knowns, those have all happened, and there's little value in those facts going forward as an investor. They're more than baked in. Right. The market is a discounting mechanism. It's looking forward. It's looking forward to the known unknowns and trying to price those.
Right. So let's talk about a few of those. So things like with COVID in the caseload, when will the cases peak, right?
Yeah. Each of these known unknowns, by definition, we don't exactly know the magnitude of the cases. We don't know when they'll peak. We don't know where this will crest, if we flatten the curve, all of that. But what what starts to take shape is you start to develop what is the market consensus. What is already being priced into the market or starting to be priced in. And what seems to be consensus now in terms of the number of cases and when we'll reach peak cases is probably not for another 8 weeks in the US. Even with effective social distancing measures, will we reach a peak caseload?
So sometime middle, end of May.
Yeah.
Right. And so that being priced in, that's a factor that a lot of people may or may not really think about in their everyday life, but the market has already said that's a reasonable outcome from here.
Yes, that's already priced in.
Okay.
And so the idea there is if cases peak in 6 weeks, that's very bullish. That's still not a great thing.
Right.
But now we're just talking about what happens relative to what's already baked in.
Right.
And how significant will the economic damage be? The market is struggling with that. Consensus is emerging that Q1 will probably be fine. 0 to slightly positive GDP growth.
Right.
Because we definitely lost some activity in March, but January and February were very strong. Right. The consensus is, and you can drive a truck through these estimates because this is rapidly evolving, but Q2 anywhere from -5 to -10%.
Right.
GDP.
I saw -14 earlier today also.
Yeah. So a significant, very sharp economic slowdown in Q2. Q3 hoping to just, coming off of very easy quarter-over-quarter comparisons, be flat, and then a very sharp recovery in Q4.
Right.
That's becoming consensus now.
And so by being consensus, that means it's technically priced in already into the equity prices, right?
Exactly. That's where you get these some folks, when you have, say, Q2 comes in at -4% GDP growth and the market rallies.
Right.
It's because it's important to know what's priced in before this happens.
Right. Yeah.
And how bearish is that? Another big known unknowns, when will we get a vaccine? How effective will it be? The consensus is starting to emerge. There are a large number of companies developing vaccines, already going to human testing starting in April, but the idea is that a vaccine will not be mass produced for at least a year. Right. So if we get a vaccine 8 months from now, 6 months from now, that's bullish.
Good. Right. Yep. What about in terms of, we've seen a lot of interesting behavior in the bond market, and it's, from our vantage point, I think we're looking at a lot of deleveraging that's been going on. That's what's been causing the bond market to sort of behave, for yields to rise as stocks have fallen, which is typically not the case.
Yes.
So how much leverage is in the system, and that's an unknown, right?
Yeah. You never fully know how much leverage is in the stock market. You have ideas. We knew there was a decent amount of leverage heading into this event. We also know a lot of leverage has come out of the system.
Right.
And you see signs of things that have been going on the last few weeks that lead you to believe a tremendous amount has come out. There's probably not that much more left in the system. You see double levered ETFs almost going to zero.
Right. Saw that today.
When those types of things get shaken out, you think we may be getting to the point where the selling froth is out, if you will.
And we've seen the Fed react to those proactively, and we haven't had any crisis while those things have happened, right?
Right.
That's a positive sign. So,
right.
And I guess that's the last item is, how effective will the fiscal and monetary stimulus be?
Yeah, definitely a known unknown. What is known is the fiscal and monetary stimulus is going to be big. The monetary stimulus has been huge.
Right.
And it's difficult to say how effective these things are going to be until we talked in a previous video about sort of the three-legged stool of this situation. Until there's an adequate health response,
right.
How effective can fiscal and monetary stimulus truly be?
Right.
So that's a known unknown. But what's starting to get priced in is that the fiscal authority, the government's taking this very seriously now, which is a good thing. And that's the amount of panic that's happening, not just in society, but also in government entities and monetary authorities, is also a good thing. They're taking this very seriously.
Yeah.
So you basically, as an investor, you chalk up all of these known unknowns, and you think, what's already baked in? How ugly is the consensus?
Right.
And then what's the probability that the outcome is actually not as bad? that's bullish,
Mm-hmm.
and what's the probability that the outcome is actually worse.
Right.
And it's a very difficult process.
That's what we're doing all day, right?
But we know historically, markets have a tendency, when there's panic like this, to build in a consensus that ends up being far more dire than what actually happens.
Yep.
And when markets are reaching all-time highs, they're building in a consensus that's far more optimistic than what normally happens.
Yep.
So that's how you go through history, all these big events, these shocks to the system. When stocks are down 30%, even say they're down 25%. That's why, since 1960, when stocks go down 25%, if you buy and hold for a year, your average return is positive 19.
Right.
Because the market tends to overreact and bake in a much more negative consensus than what actually happens.
Right. And there's always the chance that this time is different.
Yes.
And that you skew away from those types of averages. But we can only react to actual data, and we have to understand how the narrative's forming in order to sort of predict which path we're going to go down. So that sort of leads us to things that we really don't know, that could really be game changers in a positive or negative way.
Yeah.
And that we talk about quite a bit. So if we think about just the virus itself, talk about the potential outcomes there.
So to get an idea of what is an unknown, a year ago, the coronavirus or global pandemic was an unknown. Mm-hmm. It didn't show up on anybody's investment outlooks, and that's why you had such a significant market reaction.
Right.
So that's what we mean by that. So we ultimately don't know what path the virus will take.
Right.
These are all the things that, if these go the other way, they would necessitate us potentially changing our view and how we're investing portfolios.
Right.
So if we see that all of the social distancing measures and all of the testing that's gone on in South Korea and China that has allowed them to get their number of confirmed cases under control, if those fail, and once people start going back to work, they get another outbreak, a resurgence, that would be something that would cause us to potentially change our view
so
and not look at this as
changes
a
from a
opportunity.
pandemic to an endemic, where
that's exactly
it
right.
never goes away.
If this becomes like the Spanish flu and you actually have 3 waves of this and it mutates multiple times, that could definitely cause us to change our view. Additionally,
it could also adapt and become a different type of virus.
Yeah,
perhaps.
Exactly right. And then we ultimately don't know what will be the long-term effect on society. What types of new regulations will come out from this?
Right.
How will people do business in the future? Will this be so significant that we're never sitting this close to each other ever again? Do handshakes totally go away?
Hope not.
Right. All these things, those are all unknowns, and what impact do those have on businesses today, the current business models?
Some of the measures we're taking on the fiscal side of sending people actual money, how will that transform capitalism?
Yeah. Will that be the new normal?
Right.
All those types of things.
How will the bond market be transformed as an investment, from an investment thesis standpoint, when you can't buy any bonds anymore?
Right.
The government's buying all the bonds.
Yeah, there's definitely, when you go through each of these cycles, coming out of it, there's always a fundamental shift in how investors create portfolios. After 2008, when interest rates became very low and central banks started dominating markets and volatility was very low, you had people shorting volatility.
Right.
You had 2x levered short VIX ETFs. Most people don't even know what that means still. Right?
Yeah.
Those types of things could go away. People could totally think about how they construct portfolios. Dividends could be the new bonds.
Yeah. Very much so.
It's an unknown.
Yep. And we're seeing a lot of potential fiscal actions to save airlines, where they could actually, the government could nationalize airlines.
Yep.
So there's a lot of things out there that could be potential game changers that we have to sort of think through and be prepared for as this unfolds.
Right.
So just in the meantime, we've been talking to a lot of clients about these issues and about our thoughts around here regarding these issues. How or what recommendations do you have for people as they sort of sift through all the headlines, all the news, all the data to think about this?
The first is a reminder, and when we talk about those known unknowns, that the market is such an effective and efficient discounting mechanism. And there is a very good chance that everything you read, all the new information that comes out, is already reflected in stock prices.
Usually that's the case.
Yeah.
By the time you've read it, it's already reflected in prices.
And in times like this, there's an even stronger case that a situation even more dire than some of the worst articles you may be reading right now is already reflected in stock prices.
Right.
So the market is taking care of that for you most of the time. That's the first thing. The other thing is, we know in this situation, 9.9 times out of 10, the best route to take just from an investment perspective, trying to optimize your wealth and your outcomes, is to, one, not panic and maintain your level of stock exposure, and two, look for opportunities to add to equities.
Right.
We know that is the strategy that works out.
Yeah.
We've gone through these cycles.
Yep.
We have a tremendous amount of data. Each one is different, but that strategy works well in 9 out of 10 of them.
Right. And it's actually, as you sit here and look at some of these companies and their valuations and the prices you can pay for them today, and if you think, fast forward to the other side of this, some of these companies are going to be huge values.
Right.
For long-term investors. So now is the time to really be thinking about what you want to purchase for the long haul. And there's a lot of those opportunities out there.
Yeah, definitely. And the last things to think about is, we know that investing money for a lot of folks it's emotional,
Yes.
and we know there's a tremendous amount of panic. And while we say the best thing to do from an investment perspective is to maintain your equity and look for opportunities to add to it, if that creates such an emotional drain or a loss of sleep that we need to change course, because ultimately we're losing sleep at night, then that needs to happen.
That's never good.
If cash needs to be raised, we can work around that.
Yeah.
We can make that work. So, if you're feeling that way, please don't hesitate to reach out. We're having a lot of calls with clients, and that's definitely something we can work on together.
Absolutely.